what's the biggest secret to the stock market? It's not about picking the right company, it's about knowing if you have the mind of a hunter or a farmer. A hunter needs to react in seconds to catch their prize, while a farmer plans for a harvest seasons away. Using the wrong mindset will leave you empty-handed. Let's find out which one you are. Today we're going to break down the difference between trading and investing in a super simple way. By the end of this video, you'll know exactly what each one is, how they work, and which one might be the right fit for you. Before we dive in, please remember this video is for educational and informational purposes only. Always do your own research or consult with a qualified professional before making any investment decisions. So let's break this down step by step. Part 1. Let's start with trading. Just like the word suggests, trading means buying and selling. In the stock market, trading is all about purchasing stocks at a lower price and selling them at a higher price. But here's the key. This all happens in a short time frame, and traders do this frequently. We're talking hours, days, weeks, or at most, a few months. To be an effective trader, you need to master something called technical analysis. Now, what exactly is technical analysis? I'm sure you've seen those complex-looking stock charts with green and red bars, right? Those are called candlestick charts, and each candlestick tells a story about price movement. Simply put, when you see a green candle, it means the stock price went up during that time period because more people were buying than selling. A red candle? That means the price dropped because more people were selling than buying. Now, candlestick charts are actually way more complex than this basic explanation, but for beginners, this is the core concept. Traders spend hours analyzing these patterns, looking for signals about when prices will drop and when they'll rise again. Technical analysis is based on the idea that history tends to repeat itself. If a certain pattern led to a price increase before, it might do so again. Let me walk you through a realistic trading scenario. Imagine you're watching a tech company called TechFlow Solutions, and you notice its stock chart forming a pattern. Your analysis suggests the stock, currently at $15, is about to bounce back up. The golden rule of trading is simple: buy low, sell high. Most traders wait for confirmation. They want to see the stock actually starting to rise before jumping in. So you buy 5 shares at $15 each, spending $75. The stock climbs to $19. And your technical analysis shows warning signs that it might drop. You sell all 5 shares for $95. Congratulations! You just made a $20 profit. Your prediction proves correct. The stock falls to $16. You spot another opportunity and buy again. So you buy 5 shares, spending $80. This time, it rises to $23, and you sell at $115, making another $35 profit. Now, I know what you're thinking. This sounds like easy money. But hold on. The example I just gave you is every trader's dream scenario. Reality? It's much harsher. Technical analysis is never 100% accurate. You're essentially trying to predict the future based on past patterns. What if you buy at $15, expecting it to rise, but instead it keeps falling to $12, then $10, then $8? This is where traders use a safety net called a stop loss. A stop loss is like an emergency exit. You decide in advance the maximum loss you're willing to accept. For example, if you buy a stock at $15 and set your stop loss at $13, the moment it hits $13, you automatically sell to prevent further losses. You lose $2 per share, but at least you don't lose everything. Here's another painful scenario. You buy at $15, it rises to $19, and you sell, thinking it'll drop. But instead, it rockets to $28. You made a $4 profit per share, but you missed out on a potential $13 profit. This fear of missing out can drive traders crazy. There are several trading styles. Day trading, buying and selling within the same day, sometimes multiple trades in hours. Swing trading, holding positions for several days or weeks to catch price swings. Position trading, a longer approach, holding for weeks to months, riding bigger trends. And you can trade various markets beyond just stocks. You can trade in Forex, which involves trading global currencies, or in commodities like gold, silver, oil, and wheat, which are essential raw materials that often behave differently from stocks. And of course, there's the world of cryptocurrencies such as Bitcoin and Ethereum, and even the meme coins you constantly hear about. Now that you've got a clear idea of what trading actually is, let's move to the next part. Part 2. What is investing? Now let's shift gears to investing. While trading is like sprinting, investing is more like a marathon. Investing means buying assets that you believe will grow in value and generate income over time. We're talking years, even decades. If you watched my video on how stocks work, you might remember the story of Maya and her sneaker store. That's a perfect example of what investing looks like in the real world. I'll leave the link to that video in the description, so you can check it out later if you want a quick refresher. You buy a piece of a company and hold on to it as the business grows. Investors look for companies with strong fundamentals, believing their value will increase substantially over time. Plus, many companies pay dividends. They share their profits with shareholders regularly, giving you passive income while you wait for the stock price to appreciate. Unlike traders who obsess over price charts, investors focus on fundamental analysis. This means digging deep into a company's actual business health. Fundamental analysis focuses on understanding a company's true value and long-term potential. It involves examining financial statements like the balance sheet, income statement, and cash flow, and analyzing key metrics such as revenue growth, profit margins, earnings per share, and return on equity. It also considers the company's competitive position, management quality, business strategy, and future growth prospects to determine whether it's a strong investment. Why? Because nobody wants to invest in a failing company. You're looking for businesses that will thrive over the long term. Let me share an investing story. Imagine you discover a company called Greentech Energy Corporation that's developing innovative solar panel technology. After thorough research, you believe this company has massive growth potential. Their technology is superior, demand for renewable energy is rising, and they have excellent management. You decide to buy 20 shares at $25 each, investing $500 total. Over the next few years, Greentech Energy launches breakthrough products that capture significant market share. They expand globally, opening manufacturing facilities in multiple countries. Their revenue triples, profits soar. The company also pays an annual dividend of $1.50 per share. With your 20 shares, that's $30 yearly in passive income. The stock price fluctuates. Sometimes it drops to $20, other times it jumps to $35, but the overall trend is upward. You don't panic during the drops because you believe in the company's long-term potential. After holding for 6 years, the stock reached $85 per share. You decide to sell your 20 shares for $1,700. Your initial $500 investment grew to $1,700, a profit of $1,200. Plus, you collected $180 in dividends over 6 years, $30 times 6. Total return, $1,380. But here's the truth about investing. It requires incredible patience. Most of Warren Buffett's wealth came after age 65, with about 99% of his wealth created after his 50th birthday. He made his first investment at just 11 years old, became a millionaire in his early 30s, but didn't become a billionaire until his mid-50s. That's decades of patient wealth building. As Buffett famously says, nobody wants to get rich slowly. Investing goes beyond individual stocks. You can buy bonds, which are loans to companies or governments that pay interest. You can invest in funds that let you invest in a mix of assets. Real estate offers rental income and long-term growth, while cryptocurrencies provide digital assets you can hold for the future. If you want to understand how funds work in detail, I've already made a full video on that topic. I highly recommend watching it after this one. The link is in the description. Now that you understand how investing works, let's move on to the next part. It's time to break down the core differences between trading and investing so you can clearly see how they compare. Part 3. Key differences. Time horizon is one of the biggest differences between trading and investing. Trading focuses on the short term, with positions often held for just a few hours, days, weeks, or at most a few months. Investing, on the other hand, is all about the long game, with assets held for years or even decades, just like Warren Buffett, who's held his Coca-Cola stock since 1988. The analysis method is another key difference. Traders rely mainly on technical analysis, focusing on price patterns, charts, and market sentiment to time their trades. Investors, however, base their decisions on fundamental analysis, looking at company earnings, growth potential, and industry trends to choose strong long-term investments. Focus also separates the two approaches. In trading, the company's profitability or business model doesn't really matter. The only thing that matters is price movement and how you can profit from it in the short term. In investing, daily price swings aren't a big concern. Instead, the focus is on the company's long-term performance and growth potential. Risk and stress levels also differ significantly between trading and investing. Trading is generally riskier and more stressful, requiring constant monitoring of the markets. Traders often use risk management tools like stop-loss orders to automatically close losing trades, and while it's possible to make thousands overnight, you could just as easily lose it all just as quickly. Investing, however, is typically more relaxed and follows a buy and hold approach. You can buy quality stocks and check on them years later, even after 5 or 10 years, as long as the company remains fundamentally strong. Part 4. Which one is right for you? So which approach is better? You're probably wondering. The honest answer? It depends on several factors. Consider trading. If you want potentially quick returns and can handle high risk, you have time to watch markets throughout the day. It's often like a full-time job. You're disciplined about cutting losses and taking profits. You understand that most day traders actually lose money. You've thoroughly studied technical analysis and market psychology. Consider investing. If you want steady, long-term wealth building with lower stress, you have a busy life and can't monitor markets constantly. You're patient and can resist the urge to panic during market downturns. You enjoy researching companies and understanding businesses. You think in terms of years, not days. Many successful people actually do both. They might have 80% of their money in long-term investments for stability and use 20% for trading to potentially boost returns. This way, even if their trades go badly, their core wealth is protected. Now hold it, Sherlock. Before you put a single dollar into either trading or investing, please understand this. Without proper knowledge and skills, you're not trading or investing, you're gambling. And the house always wins against gamblers. Like I said before, always do your own research or consult with a qualified professional before making any investment decisions. So there you have it, the complete breakdown of trading versus investing. If you found this video helpful, now's the perfect time to give me a like and subscribe. Check out the 2 videos I mentioned earlier, how stocks actually work, and how funds like mutual funds, index funds, and ETFs work. Just click the video popping up on your screen, and I'll meet you there.